The EVOFEM Biosciences stock has been the topic of many conversations lately, and in today's video, we're going to look at its price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is still very volatile at the moment, especially for that title in particular, we should be mindful about which positions we pick up, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. EVOFEM Biosciences Inc. has had a phenomenal increase since late June, as their products have been showing promising signs that they can be commercialized soon. This has caused the stock to skyrocket compared to its penny stock level, and this has really attracted a huge amount of demand in the stock exchange. Given that the market has been in a sell-off phase since earlier this year, and arguably since the beginning of 2021, I believe that it's quite refreshing to see such a title providing a bit of contrarian price action compared to the rest of the market. The main reason behind the price rise for EVOFEM, in my opinion, is fundamental driven, meaning it may be shielded from the turmoil of the overall market. A fair question that many people may have on their mind is whether the stock will have enough steam to continue rising once the company confirms that the tests are conclusive and that the products could be sold. So my opinion is that the current phase has reached the maximum of the upward momentum, and that after such a rise, we should even expect a certain retracement in the immediate term. On the other hand, a new wave of the upward momentum could be unlocked once the products are ready to move on the next phase, and that the price could go beyond $2 or $3, if not more. The positioning of the stock should be a contrarian and marginal equity to be had on top of the other existing titles there are. We should not lose sight that the company is relatively small in its market cap, so I would recommend to treat it as such for the time being, even if it has a great potential for the future. Now, let's also take a look at the technicals of the stock. The trading volume of EVOFEM Biosciences has recently been around 51 million shares, compared to the average volume of 80 million shares. Over the previous 52-week period, the price has fluctuated between 28 cents and $15.60. The trading volume is a metric telling us how many shares are being exchanging hands and whether there's a lot of activities and attention on the stock. It often gives you a first idea about the popularity of a company. When we use it to compare it with the average volume, it can also tell us if the company is enjoying additional momentum to reverse the trend or to break through the current resistance levels. Even when the current volume is lower than the average, it is an interesting indication because it may signify that a trend reversal could happen soon. The market cap of EVOFEM Biosciences is currently around $48 million, compared to the enterprise value of $174 million. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the enterprise value is usually the cost of the company that it has already paid for its assets after paying off the debts. It's worth mentioning that one of the most significant assets they own could be the intangibles, meaning they're not items or stocks that the company can use now, but they're pledges for future potentials, such as schematics, brands, and intellectual properties. For many of those companies, those valuations occurred in more favorable market conditions than now. And this means that there could be a huge difference between the market cap and the enterprise value, giving a false impression to the market participants that a company is trading at a discount. It's only trading below its book value, but this doesn't mean that a company itself is necessarily undervalued. It's also possible that a company itself was overvalued in the first place, and that it has deflated itself back ever since. As we compare the current price to the historical price fluctuations, the stock is 380% higher than the 1-month low, 380% higher than the 12-week low, and 380% higher than the 52-week low. On the options market, which often gives you a hint of the market sentiment, the implied volatility is 253%, versus a historical volatility of 330%. The put-call volume ratio is currently at 0.03. It's normal for most stocks to also tend to have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded has been 13,000 contracts a day versus the 30-day average of 15,000. In terms of open interest, the most recent volume of open interest has been 191,000 contracts versus the 30-day average of 103,000 contracts. The option contract is a derivative product from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price, buying the contract giving people the right, and selling the contract giving people the premiums, with an obligation to execute those rights if the counterparty chooses to do so. It is often said it can evaluate the likelihood of a scenario based on the opposite of what the current ratio is. If there's a lot of put options, there might be possible uptrends on the move, or that a reversal could happen if there's a lot of call options. The reasoning behind that theory is very simple, as most options usually expire worthless. In terms of shareholder structure, institutional shareholders own 155% of the outstanding shares. The biggest shareholders include Mirador, Vanguard, and Fidelity. It's relevant to understand the shareholder composition of a company, as this can help us to determine if you should be holding the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this could be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment, and not just a short-term trade. This is obviously subjected to a lot of exceptions, since many titles are mostly held by retail investors and not the institutional ones, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there is significant short interest in the total volume, that could be a sign that there's an organized shorting operation going on, such as what happened with GameStop and AMC. The current short interest is 17% of the total float, and 51% of the transactions are coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of the short volume coming out of the dark pools, this may suggest that there are institutional positions taken to short the stock, and that there would be potentials for a short squeeze. My recommendation is to build a position over the next 3 months, and I would recommend to hold the stock for more upward momentum potential, which I think is likely to occur. I would recommend to commit between 1 to 3% of your portfolio in the stock, and would further recommend to split the allocation in batches of 20% at a time, so that you can purchase more if it retraces. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect in the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.